Hey everyone, welcome back to We Are Cosmic, the channel where we break down cryptocurrency and the financial world in a way that makes sense, even if you're just starting out. If you've been following crypto for a while, you've probably seen the headlines, the tweets, and the wild predictions about XRP. People talking about turning a small $1,000 investment into tens of thousands, sometimes even claiming life-changing gains in a very short period. Now I get it, your first instinct might be to roll your eyes. You've seen the moon talk before, but today, we're not chasing hype. We're diving into a serious professional look at why these numbers are showing up in 2026, and why they may not be as impossible as they seem. On January 5th, 2026, the conversation around XRP changed dramatically. Analysts, investors, and even institutions started talking about a very aggressive financial projection. $1,000 in XRP today could realistically become $50,000 over time. That's a huge leap from what most people expected, and it immediately grabbed the attention of the entire cryptocurrency world. But this isn't just speculation. Behind this number lies a combination of historical trends, liquidity changes, and structural shifts in how digital assets are integrated into the traditional financial system. Understanding this requires a step back from the everyday hype and a close look at the mechanics that actually drive these predictions. Now, before you think this is just a dream scenario, let's ground ourselves in reality. The key here is understanding the math, the historical patterns, and the influence of institutional money. Analysts have noticed that XRP is showing signs of a historical breakout pattern that could, under the right conditions, lead to extreme gains, sometimes as high as 5,000%. These aren't baseless guesses. They're based on liquidity charts, institutional flows, and a deep look at XRP's integration with global banking infrastructure. This means that while $50 or even $100 XRP sounds wild, it is not mathematically impossible if the conditions align. So why now? Why is 2026 different from all the previous years of speculation? One major reason is the launch of the spot XRP ETF in late 2025. This marked a turning point in XRP's relationship with institutional investors. For the first time, large financial players could hold XRP in a regulated manner, integrating it into their portfolios alongside traditional assets. This changed the fundamentals entirely. XRP was no longer just a coin traded on exchanges. It became a financial product with real institutional demand, which created a much stronger price floor. That's important because it signals a move from speculative buying to long-term strategic accumulation, which is the kind of foundation that can support extreme growth over time. Another crucial factor is the concept of a liquidity vacuum. Simply put, as more XRP is moved off public exchanges into institutional custody or cold storage, the amount of XRP available for trading shrinks. When supply is limited but demand continues to grow, especially from smart money investors, the price can react dramatically. This is exactly the type of environment that supports higher price projections. It's not just hype or social media influence. It's a fundamental market dynamic based on supply and demand, and it's happening right now. Finally, let's talk about why you should care as an individual investor. These projections are not about lottery tickets. They're about understanding how XRP is transitioning from a simple digital currency into a critical financial infrastructure tool. By looking at the flows, the institutional adoption, and the liquidity trends, you can start to see a bigger picture. XRP is no longer just a coin. It's a bridge between traditional finance and the digital world, and that's the foundation for the future price potential we're discussing. One of the most important changes for XRP came in late 2025 with the launch of the spot XRP ETF. This was a game changer. Before the ETF, the majority of institutional investors avoided XRP because it was unregulated and considered risky, mainly due to the SEC lawsuit. They simply could not hold it in their portfolios without running compliance risks. But the ETF changed that overnight. Suddenly, XRP could be held safely by banks, hedge funds, and large investment firms, creating a new wave of demand that wasn't influenced by social media hype or short-term traders. This is critical because institutional money behaves differently. Unlike retail traders who react emotionally to headlines or price swings, institutions accumulate strategically and steadily. They are not concerned with daily volatility. They are focused on long-term growth and liquidity management. Speaking of liquidity, we need to understand the liquidity vacuum. This is a key factor in XRP's potential price movements. As institutional investors buy XRP, more coins are moved off public exchanges into cold storage or secure institutional wallets. What does this mean? The available supply for public trading drops significantly. When supply tightens while demand continues to grow, even small purchases can cause sharp price spikes. This is not speculation, it's market mechanics. Historically, markets respond strongly when a limited supply meets sustained demand, and XRP is now entering that exact environment. To put this into perspective, XRP has seen billions of dollars flowing into institutional hands in the months following the ETF launch. These inflows are structurally reducing the circulating supply. Imagine a market with fewer sellers but more buyers who are ready to pay higher prices. This is the kind of environment that can support aggressive price targets like $50 or even $100 per XRP in a multi-year horizon. It's not a lottery, it's supply and demand in action, amplified by smart, patient money. Another factor is the removal of regulatory risk. Back in May 2025, Ripple Labs reached a settlement with the SEC, ending a multi-year lawsuit that had weighed heavily on XRP's price. For years, investors were essentially buying a coin with legal uncertainty attached. The settlement removed that major barrier. Institutions now have the confidence to invest without fear of regulatory consequences. Combined with the ETF, this created a perfect storm of legitimacy and accessibility, which is why institutional adoption accelerated so quickly. Now let's connect the dots. We have institutional capital flowing in, a shrinking liquid supply, and regulatory clarity. These three pillars create a market where XRP's price can react more sharply to new demand than it ever could before. For instance, even modest buying pressure in this environment can push prices upward dramatically because the coins available for trading are limited. This is the structural foundation behind those bold 2026 predictions we discussed in Part 1. It's not guesswork, it's strategic market dynamics. Finally, as an investor, it's important to understand that this isn't a short-term sprint. Institutional adoption takes time. ETFs accumulate steadily over weeks, months, and years. Liquidity shifts gradually. Prices may not spike overnight. Patience is essential. This is why the roadmap for XRP isn't just about excitement or headlines. It's about understanding how large financial systems integrate with digital assets over time. In summary, the launch of the XRP Spot ETF, combined with billions in institutional inflows, shrinking exchange supply, and regulatory clarity, has fundamentally changed the dynamics of XRP. These factors create a market structure where large gains become mathematically plausible, not impossible fantasies. XRP is no longer just a retail coin, it's a growing institutional asset that is steadily moving into the mainstream financial world. For years, critics labeled XRP as a one-trick pony. They argued that it was fast and cheap for payments, yes, but it lacked the flexibility and developer ecosystem of networks like Ethereum or Solana. This perception is now changing. The XRP ledger, XRPL, is undergoing a transformation, moving from a simple payment rail into a programmable platform for financial applications. By integrating smart contracts and developer tools, XRPL is no longer just a highway for moving money. It's becoming a foundation where complex financial applications can be built directly on the ledger. One of the biggest technical advancements in 2026 is the rollout of smart contracts and hooks on the XRP ledger. These hooks allow developers to attach programmable logic directly to transactions, enabling automated financial flows, decentralized finance, DeFi applications, and complex settlement processes. This expansion significantly changes XRP's utility. Previously, demand was mostly speculative or focused on payments. Now the token is becoming the fuel for a new financial ecosystem, which introduces a structural reason for long-term price growth. Another game-changing innovation is privacy through zero-knowledge proofs, ZKPs. One of the main reasons large banks have historically avoided public blockchains is privacy concerns. They cannot allow competitors to see their liquidity positions, client transactions, or settlement data. With ZKPs, the XRP ledger can verify that transactions are compliant and valid without revealing sensitive information. This selective disclosure model balances privacy for institutions and transparency for regulators, which is exactly what is required for global banks to adopt blockchain for real financial operations. Essentially, ZKPs unlock the institutional demand that was previously impossible to access. Closely tied to privacy are confidential multi-purpose tokens, MPTs, set to launch in early 2026. These tokens are designed for tokenizing real-world assets, RWAs, including real estate, commodities, private credit, and government bonds. MPTs allow these assets to be digitally represented, traded, and managed directly on the XRPL while maintaining privacy and regulatory compliance. For example, a single skyscraper could be divided into millions of tradable shares, allowing global investors to participate instantly. The integration of RWAs into XRPL opens up a multi-trillion-dollar market for tokenized assets, which could dramatically increase the demand for XRP as the underlying liquidity bridge. All these technical upgrades, smart contracts, hooks, zero-knowledge proofs, and confidential MPTs are not happening in isolation. They align perfectly with the institutional adoption trend we discussed in Part 2. The XRPL is positioning itself as the primary rail for both payments and complex financial applications, bridging traditional finance and DeFi. By enabling banks and financial institutions to securely move and manage trillions of dollars without compromising privacy, XRP becomes an essential tool in global financial infrastructure. Another key factor is interoperability with Ethereum and other networks. The introduction of the XRPL EVM sidechain and bridges like Wormhole and Axel allows Ethereum-based assets and smart contracts to interact with the XRPL ecosystem. This connection acts as a liquidity multiplier, bringing billions of dollars in DeFi capital onto the XRP ledger while retaining speed and cost advantages. By tapping into existing decentralized finance ecosystems, XRP expands its utility and demand, further supporting the case for long-term price growth. To summarize, XRP's technical roadmap in 2026 is a major catalyst for adoption and value appreciation. Smart contracts, hooks, privacy through ZKPs, MPTs, and interoperability create a structural reason for both retail and institutional demand. The technology now supports not just money movement, but the tokenization of real-world assets, complex financial applications, and confidential banking operations. When combined with institutional inflows and reduced liquidity, this technological evolution strengthens the case for XRP reaching higher price levels over the coming years. We've covered institutional adoption, liquidity flows, and the XRP ledger's technical roadmap. Now, let's take a closer look at the next major catalyst, real-world asset tokenization, RWAs, and how XRP's integration with other blockchain networks is creating massive liquidity potential. Real-world assets are exactly what they sound like. Physical or legal assets represented digitally on a blockchain. This includes things like real estate, commodities, corporate bonds, and government securities. XRP is uniquely positioned for this because of confidential multi-purpose tokens, MPTs, launching in early 2026. MPTs allow fractional ownership, meaning one skyscraper can be divided into millions of digital shares, instantly tradable globally. The significance here is enormous. The total value of the global real estate market alone is in the hundreds of trillions of dollars, and even capturing a small fraction of that market could create unprecedented demand for XRP. But tokenization isn't just about creating digital assets, it's about securely transferring value and ensuring that institutions maintain privacy and compliance. This is where zero-knowledge proofs, ZKPs, play a critical role. Banks can move massive amounts of money or tokenized assets without revealing sensitive data, while regulators still verify that everything is compliant. Essentially, XRP becomes the underlying liquidity bridge for a new kind of financial infrastructure, one that can handle trillions in global assets without compromising speed, security, or privacy. Another massive driver is cross-chain interoperability. Historically, XRP was a fast and efficient network, but largely siloed from other ecosystems, especially Ethereum. In 2025, the launch of the XRPL EVM sidechain, along with bridges like Wormhole and Axel, created high-speed highways between XRP and Ethereum-based assets. This integration allows billions of dollars in DeFi liquidity to flow into the XRP ecosystem, amplifying the total capital moving through the network. Think of it like connecting a high-speed financial freeway directly to the largest existing money streams in the crypto world. This isn't a minor technical upgrade. It's a liquidity multiplier. These combined factors, tokenization of RWAs, privacy through ZKPs, and cross-chain bridges, set the stage for a structural supply-demand imbalance that can push XRP's price higher. Institutional inflows are already shrinking the liquid supply on exchanges. Now, when you layer in billions more flowing from cross-chain bridges and DeFi capital looking for fast, secure, and programmable rails, the market is under pressure to absorb enormous amounts of capital with limited available supply. This is exactly the environment that supports the bold projections we discussed in Part 1, where $1,000 investments could multiply significantly over time. It's also important to understand timing and patience. These transitions, RWAs, institutional adoption, and cross-chain liquidity, don't happen overnight. The flows occur over months and years, gradually absorbing liquidity and expanding XRP's use in global finance. Investors who expect instant gains will likely be disappointed. However, those who align their timeline with the gradual integration of technology and capital are positioning themselves strategically for long-term upside. In short, XRP is no longer just a digital coin for retail trading. It's evolving into a backbone for the next generation of global finance. By tokenizing real-world assets, connecting DeFi liquidity from other chains, and providing privacy and compliance, XRP becomes essential for institutional investors. Every new RWA brought onto the ledger and every cross-chain capital flow adds structural demand, further reducing available supply and strengthening the foundation for higher prices. We've explored XRP's institutional adoption, technical roadmap, and real-world asset tokenization, showing how these factors create structural demand. Now let's dive into one of the most critical drivers of price potential, the supply dynamics and liquidity vacuum. Understanding this is key to seeing why aggressive price targets like $50 or even higher are mathematically plausible over time. For years, XRP's price was constrained by the available supply on exchanges. No matter how much institutional interest existed or how promising the technology became, a large portion of XRP was always liquid and easily tradable. This meant that significant buying pressure could be absorbed without drastically moving the price. But in 2026, we are seeing a major shift in supply distribution. Billions of dollars of XRP are being moved into cold storage or institutional custody, dramatically reducing the coins available for public trading. This is what analysts call a liquidity vacuum. A liquidity vacuum occurs when demand remains constant or grows while supply shrinks. In this environment, even modest buying pressure can create rapid and significant price movements, because there simply aren't enough sellers at the current levels to absorb new capital. In other words, the market becomes extremely sensitive to capital inflows, which makes price appreciation more likely. This is why supply constraints are not just a minor factor, they are a structural element in XRP's potential for dramatic growth. Now combine this with institutional inflows from ETFs and cross-chain liquidity bridges, and the picture becomes even clearer. Every day, billions of dollars are being funneled into XRP, but the supply on exchanges is shrinking. This creates a mathematical inevitability. Price levels must adjust to balance the limited coins available with the growing capital entering the system. Analysts often point to this as the silent engine behind multi-digit price predictions. While retail investors may focus on news events or social media hype, the real driver is the structural imbalance between supply and demand. Another key point is timing. The liquidity vacuum doesn't instantly translate to price spikes. It unfolds gradually as institutions accumulate and as assets are locked into long-term custody. This means that aggressive targets like $50 per XRP aren't necessarily a short-term prediction. They are achievable over months or even years, depending on the pace of institutional adoption and network activity. Investors must align their expectations with this multi-year structural shift rather than expecting overnight gains. This also ties back to the technical evolution we discussed in Part 3. As XRP's ledger becomes capable of handling smart contracts, confidential MPTs, and cross-chain transactions, demand for XRP as a utility token increases. The more XRP is needed to facilitate these new applications, the tighter the liquid supply becomes. In essence, technology drives demand, demand drives scarcity, and scarcity drives price, creating a feedback loop that could support the extreme growth scenarios we've discussed. Finally, it's worth noting that this supply-driven mechanism is different from hype or speculation. It is structural, measurable, and observable. The combination of shrinking exchange supply, continuous institutional inflows, and rising utility from RWAs and smart contracts creates an environment where XRP's price can move dramatically in a rational, predictable way. The three-digit price targets we hear about are not wild guesses. They are grounded in mathematical and market realities, assuming these conditions continue to align. In short, the liquidity vacuum is the hidden engine behind XRP's potential. It amplifies the effects of institutional adoption, technical growth, and real-world asset integration. Understanding this is essential for any investor looking to make sense of XRP's aggressive price projections. We've explored institutional adoption, technical innovation, real-world asset integration, and supply dynamics. Now it's time to bring it all together and look at the full 2026 blueprint for XRP. This is where we connect the dots and understand why the predictions you've been hearing, while aggressive, have a logical foundation. First, let's talk about legal clarity. For years, XRP was under a cloud of uncertainty because of the SEC lawsuit. Investors weren't just buying a coin, they were buying a legal liability. Every price move was shadowed by the question, will regulators intervene? That changed on May 8, 2025, when Ripple Labs reached a settlement with the SEC. This was more than just a company victory. It removed the primary obstacle to institutional adoption. Banks, hedge funds, and other financial institutions can now safely hold and integrate XRP into their operations. Legal clarity transformed XRP from a risky asset into a credible financial instrument, which is essential for supporting multi-digit price projections over the long term. Next, let's focus on long-term strategic planning. Aggressive price predictions, like $50 per XRP or beyond, are not about short-term speculation. They are about multi-year structural growth. Investors must align their personal timelines with the adoption, integration, and technological evolution of the XRP ledger. Patience is key. Market volatility can be intense in the short term, but when we step back and look at institutional flows, liquidity constraints, RWAs, and technical adoption, we start to see a much clearer picture. XRP's growth is measured in years, not days, and those who understand this have a distinct advantage. The 2026 blueprint combines four main pillars. Institutional adoption. With the launch of the spot XRP ETF, billions of dollars are moving into the asset. Institutions accumulate XRP steadily, reducing available supply and strengthening the price floor. Technical evolution. Smart contracts, hooks, zero-knowledge proofs, and multi-purpose tokens transform XRPL into a programmable, privacy-preserving financial platform, expanding XRP's utility beyond simple payments. Real-world asset integration. Tokenizing assets like real estate, commodities, and bonds create structural demand as XRP becomes the liquidity bridge for trillions of dollars of digital value. Supply and liquidity dynamics. A shrinking exchange supply combined with new inflows from institutional investors and cross-chain liquidity bridges amplifies upward price potential in a predictable, measurable way. When you put all these pieces together, the picture becomes clear. XRP is no longer a coin that reacts to hype or short-term news. It's evolving into a critical component of the global financial infrastructure, bridging traditional finance with DeFi, supporting trillions in tokenized assets, and providing privacy and compliance for institutions. The aggressive price targets you hear about are based on real market mechanics, technology adoption, and structural supply-demand forces, not just speculation. However, it's important to remember that these projections are conditional. They depend on continued adoption, sustained liquidity flows, and a gradual integration of RWAs and institutional operations. The key takeaway is that XRP's future growth is logical, measurable, and time-dependent. Success requires a plan that matches your financial goals and a willingness to play the long game rather than chasing daily volatility. So, what should you do as an investor or crypto enthusiast? Educate yourself, track institutional flows, understand the technology, evaluate the timeline realistically, and most importantly, align your expectations with structural market changes, not just headlines. To summarize, XRP's journey in 2026 is not about hype. It's about a strategic, multi-year transition. From legal clarity and institutional adoption to technical upgrades and liquidity-driven price mechanics, every factor points to a fundamental shift in how the market values XRP. The blueprint is clear. This isn't a short-term gamble. It's the building of a new financial system in real time. That wraps up our 6-part deep dive on XRP for 2026. If you found this helpful, make sure to hit that like button, subscribe to We Are Cosmic, and check out our other videos on institutional adoption and technical analysis. Stay curious, stay patient, and always focus on the bigger picture.